A great afternoon, everyone. Welcome to the Marketplace. Coming up in this bulletin, Monetary Policy Committee of the Bank of Ghana set to announce a new policy rate after a meeting to review developments in the economy over the past 2 days. We are live at the Bank of Ghana for the very latest. Ghana's total export earnings reach a record level of $23 billion, a development that could aid cedi's appreciation and boost reserves. Plus, Ghana Revenue Authority declares war on smuggling as the country's entry points placed on high security alert.
Continue to make arrests of individuals involved in smuggling activities, protect border against unauthorized movements, and actively identify and close off multiple illegal routes used for evading duty payments.
We have details of these and more lined up for you. Please stay on. Thanks so much for your company. I am Pius Kojobaka, and looking at our stories. The country's total export earnings continue to reach record levels. New Bank of Ghana data puts the amount at $23 billion, ending October this year. Details in this report.
This $23 billion that the country realized from its exports actually represents a significant increase from the about $15 billion secured in the same period for last year. Gold brought in the highest amount because as at the end of October this year, the country secured $15.2 billion. It was followed by cocoa, which earned $2.8 billion, whilst oil earnings stood at $2.2 billion. On the other hand, the country's import bill was still rising, a development that can be said not to be that good in terms of our strong reserves build-up. Ghana, from January to October this year, spent $14 billion to finance its import needs. Non-oil imports accounted for more than $10 billion. The development resulted in a trade balance reaching another record level. If all these export earnings are coming back to the country, then that should be seen as good for the economy, especially when it comes to the city's stability, strong reserves build-up, and some subtle investor confidence in the economy.
The Monetary Policy Committee of the Bank of Ghana is getting ready to announce a new policy rate, and this was after it met to review developments in the economy over the past few days. We have more for you in this report.
One thing that is clear is that the policy rate, which currently stands at 21.5%, will go down. However, we still cannot establish the margin of reduction. That is, are we going to witness another huge reduction in the policy rate? The Monetary Policy Committee of the Bank of Ghana has always been guided by the risk to the economy in terms of outlook. Now, looking at the current data, it is clear that there is no major risk, and that may result in the Bank of Ghana going for a significant cut in the policy rate. But for some individuals, it might not be good for the Bank of Ghana to go on this path due to some marginal threat to the economy when it comes to commodity prices potentially going down and their impact on the broader economy. That is why others have argued that we may not see that huge cut in the policy rate. Many will also be looking forward to the Bank of Ghana's latest verdict on the economy after their review over the past 2 days.
And right about now, we want to cross over to the Bank of Ghana for the very latest in relation to the announcement of the Monetary Policy Committee meeting with regards to the policy rate. Let's now cross over to the Central Bank.
Together, the gains indicate that the negative output gap is closing so far. The expectation is that should this momentum be maintained in September 2025, the GDP growth outturn for the year will remain strong. Now on inflation. Inflation decline in the year has been steady and on target. From 23.5% in January 2025, headline inflation has eased to the bank's central target of 8.0% in October. The decline was broad-based as both food and non-food inflation are currently in single digits. And let me say that this is the first time since July 2021. The sustained disinflation has been driven by the continued maintenance of a tight monetary policy stance, sustained fiscal consolidation efforts, a stable currency, and relative improvement in food supply. Also, the bank's core inflation measure, which excludes energy and utility, has declined, reflecting significant moderation in underlying inflationary pressures. Price expectations by consumers, businesses, and the banking sector for the next year signal well-anchored inflation expectations. The bank's latest near-term forecast show that inflation will continue to decline and settle between 6.6 to 8% by the end of the year. On interest rates, these have generally declined in line with the reduction in the monetary policy rate. The interbank weighted average rate declined to 21.0% in October 2025 from 27.7% in the same month of 2024. The interest equivalent of the 91-day benchmark rate eased to 10.6% in October 2025 from 25.8% in October 2024. Also, average bank lending rate declined to 22.2% compared with 30.5% in the same comparative period. This has triggered a gradual recovery in private sector credit growth. From 7.1% contraction in May 2025, private sector credit growth in real terms has improved to 5.4% in October 2025. Now, on the fiscal side, budget performance over the first 9 months was marked by strong fiscal consolidation, as announced recently by the Finance Minister in his budget presentation. Revenue and grants fell below the target by 4.7%, while expenditure was below the target by 15%. This resulted in an overall fiscal deficit on commitment basis of 1.5% of GDP, which was better than the target deficit of 3.2% of GDP. The primary balance on commitment basis recorded a surplus of 1.6% of GDP compared with the target of 1.0%. As at end of October 2025, the total public debt stock was 45.0% of GDP compared with 61.8% of GDP at end December 2024. The decline in the public debt was attributed to effective debt management, reduced borrowing costs, and appreciation of the local currency. Deposit money banks remain sound, profitable, and well capitalized. The financial soundness indicators, including solvency, profitability, asset quality, and efficiency indicators, these all point to relative improvements in year-on-year terms. The non-performing loans ratio declined to 19.5% in October 2025 from 22.7% in October 2024. And this was driven by pickups in bank credits and contraction in the stock of NPLs. However, credit risks remain elevated, and looking ahead, policy actions to recapitalize the few undercapitalized banks and full implementation of the new regulatory guidelines that are aimed at reducing NPLs would further strengthen the banking industry. Now, on the external sector. The external sector conditions remain favorable. The current account improved significantly in the first 9 months of this year to a surplus of $3.8 billion compared to a mere $553.6 million in the same period last year. The trade surplus increased to $7.5 billion on the back of a surge in gold and cocoa export earnings. Private inward transfers remained high at $6 billion at the end of the third quarter. The current account surplus, together with favorable balances in the capital and financial accounts, translated into an overall balance of payments surplus of $1.8 billion and supported an accumulation of reserve assets to $11.4 billion in October 2025. And I must say that this is equivalent to 4.8 months of imports cover. Reserves are projected going forward to increase even further by the year end. The reserve accumulation efforts have helped indeed to provide cushion for the currency, with the CD strengthening against the major trading currencies. In the year to 21st November 2025, the CD recorded an appreciation of 32.2% against the US dollar. Now, in taking the policy decision, the view of the committee was that overall macroeconomic conditions have broadly improved. Given the anticipated significant decline in inflation by the end of the year, the tight monetary policy stance, the significant buildup of reserves, which is providing anchor for exchange rate stability, the bank projects a continued stable inflation profile around the target and well into the first half of next year, 2026. This is against the backdrop that current risks in the outlook to shift the path of inflation away from target have moderated significantly. Hence, the prevailing high real interest rates provides some scope to ease policy to further boost the growth recovery efforts. So, given these considerations, the committee, by a majority decision, voted to lower the monetary policy rate further by 350 basis points to 18.0%. The committee will continue to monitor developments and take the appropriate policy decisions to ensure sound and stable macroeconomic conditions. But we have one additional measure. In addition to the policy rate reduction, the bank will now return to the use of the 14-day bill as its main instrument for conducting open market operations. The next Monetary Policy Committee meeting is scheduled for January 26 to January 28, 2026. And the meeting, as usual, will conclude on January 28 with the announcement of the policy decision. I thank you for your attention.
Thank you very much, Governor. This is the 127th MPC press briefing of the Bank of Ghana, and you just heard the Governor, Dr. Johnson Isiama, giving us the decision of the committee. Members of the press, this is the time for you to come in. And as you already know, you mentioned your name, the media house you represent, and for brevity, kindly make your questions simple, okay? And kindly listen to the one before you repeat all the questions all over again, okay? So no repetition. So let's go.
My name is Joshua Amulano with the Business and Financial Times. So, Governor, with regards to the additional measure of 14-day bill, is that to say that the 56-day as well as the 276 is being taken off the market? And is this additional measure meant to reduce your activity with regards to the home operation on the market?
Yes, thank you, Joshua.
Okay, thank you.
We are taking 4 questions for each one. Yes. George,
okay. So, Doc, I monitored this is George Biaffe from Joy FM, Joy News. When I listened to your opening remarks during the opening of the MPC, you gave us a very strong indication that it's not even about present, but per your extrapolations and all those things, the outlook is very favorable. You don't see anything coming in to destabilize things. Do you think that the 300 basis point is enough based on all the data that you have put out and even the comments that you put out that give us an indication that things are quite strong and the outlook is solid? Couldn't we have gone down further as you try to deal with the challenge of the treasury bills issue and then the investor interest as well? Doc, are we also in a very strong position now that we can go and sleep when it comes to the CD's performance, looking at your reserves? If the commodities change direction, just like what has happened to cocoa, and gold prices begin to drop, are we in a strong position to even manage it for the next maybe 6 months? Thank you.
Right, I think, George, you took someone's question away, so take the last question for this round, please. Yeah, Thomas.
Sorry. Good afternoon, Governor. My name is Toma Imere from Corporate Guardian magazine. Governor, some months back, you said that we are expecting about 4 billion from cocoa inflows before the end of the year. Since that time, the spot price for cocoa has fallen from close to 8,000 to just over 5,000 currently. How would that affect the inflows which you stated were expecting from cocoa? And to what extent can the surge in gold inflows offset the expected shortage from lower prices on cocoa? Thank you.
Yeah, thank you, Thomas. Governor, you have the floor now. Thank you.
Okay. Do we take those? Or one more? We can take one more and then. Yes.
We already have 5.
I have 3 here.
Yes.
DFT, Joy FM, Toma.
Yes.
Who else?
George gave us 2.
Oh, George gave 2.
Yes.
Can I repeat it? Or?
Yes.
Okay. Yeah. Okay. So basically 3 on the 14th day. It's not actually a new thing. It has always been there, and the central bank has to be operating on the very short end of the market anyway. So it's just going back to where we are supposed to be operating. We used to have even the 7 days some time ago. So usually you find us making use of the very shorter, term bills, and that's exactly what we want to do. We want to discontinue the use of the 56-day and the likes. Remember, we even issued a 273-day instrument some time ago, but now we want to reset to the very shorter end of the market, and so that is what it is. It's not a new thing. We are just going back to where we are supposed to be operating from. George, I had one question, but I hear it's 2 in 1. Could we have cut further? I remember what we said at the last policy meeting. We are following the outlook for inflation. We believe that the 350 basis points is in line with our program and also consistent with the disinflation path. But that said, it's about assessing the risks on the upside to inflation and also the risks on the balance of the risks as a result. From where we stand, we believe that the 350 basis point is enough. Remember, we've now settled, very well within the target band, and we will be observing these going forward. If there's the need for the committee to take any additional policy measure, that will be done. But from where we are currently, right now, we believe that the 350 basis point is very much in line with the disinflation program. Then you asked about if commodity prices, shot up against us. Yes. And that's exactly why we are emphasizing our reserves build-up program. As I've indicated, we are seeing a steady rise in our reserves target. We have already achieved what under the fund program we should have achieved by the end of December. We are ahead of the curve. And that has been our emphasis. Reserve accumulation, reserve build-up, right? FX intermediation, very little by way of, even if we have to stem excessive volatility, that's the approach. And that will continue to be it. And that's the best way to shoot, to show up against any changes in commodity prices, as you have indicated. Then Thomas spoke about cocoa prices. But if you check the data pack, the details are there on cocoa price movements. It suggests otherwise. Now, the inflows we have had through Cocoa Board so far shows that the inflows are doing very, 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 well. Year to date, from cocoa alone, we have received about $2.7 billion from cocoa. So cocoa is actually surprising us. What I said earlier was in respect of the entire cocoa season, not only, from now till end of this year. I was projecting over the entire cocoa season. So cocoa is doing pretty well. We hope that the trend sustain. It, together with remittance inflows, will help to support the stability. Those are the ones I have. If there's another, you can remind me.
Yes, I think that's all. The second part of your answer answered what George was looking at. Basically, he was looking at whether the reserve accumulation will be supportive of the city going forward. And I think in what you submitted.
Right, so you just watched the Bank of Ghana governor giving some updates on the economy in relation to the health of the economy largely, and of course, going further to reduce the policy rate by 18%. And of course, you saw the journalists asking questions to the governor basically on the policy rate cut, etc. We shall be bringing you more in our subsequent bulletins. But before we part company, the Ghana Revenue Authority has intensified surveillance at the country's border posts to effectively deal with smuggling and persons evading taxes due to the state. Now, this follows seizure of more smuggled goods, with a recent one worth more than 3 million cedis in terms of taxes due to the state. Commissioner General of the authority, Anthony Kwesi-Sapong, vowed to deal with recalcitrants engaged in this practice.
Kills businesses, takes away job opportunities for our people, and denies the state the necessary revenue for national development. If you smuggle and we arrest you, we will confiscate your goods and you will lose your capital to the state. Our appeal to businesses is to avoid smuggling and save your businesses. Let us remember to know our taxes, to pay our taxes, and to build Ghana together. In this respect, GRA will continue to make arrests of individuals involved in smuggling activities, protect border against unauthorized movements, and actively identify and close off multiple illegal routes used for evading duty payments. We would like to assure the public, the business community, and stakeholders that GRA will relentlessly pursue its mandate of border protection and revenue collection. We will not accept any attempt to circumvent our systems and processes. We therefore call on businesses who are genuinely complying with their tax obligations to continue to do so. However, we will apply all necessary enforcement measures to curtail activities of individuals and businesses who do not comply with the law, particularly who engage in smuggling.
And that's it for Business Live. Marketplace, I should say. I am Pius Kojo-Baka. We shall connect at 5 p.m. for Business Live. But feel free, you can log on to myjoyonline.com/business. Always a delight serving you. See you soon.